In 2026, the U.S. stock market is going through one of its most important transitions in decades. For years, investors were spoiled by cheap money, low interest rates, and aggressive growth fueled by easy borrowing. But that era is over. Rising interest rates have fundamentally changed how the market behaves, how companies operate, and how investors make decisions. Understanding this shift is no longer optional. It's essential for anyone serious about investing. To fully understand what's happening, we first need to understand why interest rates matter so much. Interest rates determine the cost of money across the economy. When rates rise, borrowing becomes more expensive for businesses and consumers alike. Companies now think twice before taking on debt, expansion plans slow down, and profits are examined more carefully. This single change creates a chain reaction that spreads across every sector of the stock market. One of the biggest impacts of rising interest rates in 2026 is on growth stocks. Over the past decade, technology and innovation-driven companies dominated the market because investors were willing to pay high prices for future potential. But higher interest rates reduce the value of future earnings. Suddenly, companies promising profits 5 or 10 years down the road don't look as attractive. As a result, many once popular growth stocks are facing pressure, corrections, or long periods of sideways movement. While growth stocks struggle, value stocks are quietly regaining attention. Investors are shifting their focus toward companies that generate real profits today, not just promises for tomorrow. Businesses with strong cash flow, stable earnings, and reasonable valuations are becoming more desirable. In 2026, this rotation toward value is reshaping portfolios across Wall Street and among retail investors. Financial stocks are among the biggest beneficiaries of rising interest rates. Banks and lending institutions earn more money when interest rates are higher because they can charge more on loans while paying relatively less on deposits. This improves profit margins and strengthens balance sheets. As a result, financial sector stocks are becoming a core holding for investors seeking stability in an uncertain market environment. Rising interest rates are also changing consumer behavior in noticeable ways. Mortgages, car loans, and credit card debt are more expensive than they were just a few years ago. This forces consumers to cut back on discretionary spending and focus more on essentials. Companies that rely on luxury spending or impulse purchases are feeling the pressure, while defensive sectors like utilities, healthcare, and consumer staples are holding up much better. In conclusion, rising interest rates are reshaping the U.S. stock market in powerful and lasting ways. The age of easy money is over, and a new era of disciplined investing has begun. Those who understand this shift, adjust their strategies, and stay patient will be better prepared to protect their capital and build long-term wealth in the years ahead.